Have you ever wondered how to pick a great small cap fund without getting confused? Give me only 5 minutes and I'll reveal my powerful framework called Flash. And today I'm going to use it to analyze India's largest and most popular small cap mutual fund, the Nippon India Small Cap Fund. A 10,000 per month SIP in it with a 5% annual step up would have grown to over 50 lakhs in just 10 years. But it's also the largest small cap mutual fund in India. So is that a problem, and is it worth all the hype? Let's put the flash on it as I analyze it step by step live in the third episode of this Flash series. In the Flash framework, F stands for fundamentals, L for long-term results, A for allocation and approach, S for stress and stability, and H for how it fits your portfolio. Hello everyone, I am Udayan Adhye and I've been licensed in Indian financial services since 2015, and so far I've helped over 1,500 families take better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. So F for fundamentals, that's the first aspect that we want to look at, right? In it, we want to check the credibility and the reputation of the mutual fund house and the category of the fund. So to do that, I'm just going to simply Google the name of the fund, the Nippon India Small Cap, and you'll see multiple links here. All these websites are fantastic and have their own benefits in their own ways. I personally prefer looking at value research online, so I'm going to go there. None of the websites I mentioned, tools I mentioned, funds I mentioned here are sponsored by any means. It's completely unbiased. Once you're on the value research page of the fund that you want to research, you want to check these two things here. So what type of a fund it is. So it's an equity fund. That means it invests in stocks. And further, what is the category of the mutual fund? So in this case, it's a small cap mutual fund. It's very evident with the name, yes, but at times it's not evident with different names. What this tells you is that you at least want to have an investing horizon of 6 to 7 years if you want to invest in this type of a fund. So if you have a shorter investment horizon, then don't even look at a small cap fund. So that's the first thing. Now with regards to the reputation of the fund house, which is Nippon India in this case, you can go through hours of research, you can read hours of interviews, there are ways to find out the fund manager and everything else through value research as well. But instead of doing any of that, right, you can simply use AI. It's one of the most basic, straightforward and excellent use cases of artificial intelligence. And I'm going to use ChatGPT this time, and I'm going to use their O4 mini model. It's their reasoning model. If you had seen earlier episodes of the Flash series, you would have known that I use Perplexity AI. And I'll show you comparisons of different results. But I personally love using O4, or even better, the O3 version. But O4 is the one I've chosen now because that's also available, I think, for the free version of ChatGPT. So this is the prompt that I feed into ChatGPT. You can find this for free just below the like button. But once I share that, right, I just have to change this name so if you are analyzing a different fund, just change that last row and you will get an analysis of that fund. So here you go, right? AMC credibility. We want to first check that. We want to see the fund managers who are like the captain of a team, right? They're pulling all the shots. So we want to ensure that they have the credibility, they have the reputation, they have been managing the fund for a long time. Right away, that there are no major controversies in the past 5 years, which is wonderful. You can go through this in detail, but I'll go through the highlights right now. Then with respect to the fund manager, Samir Rach has been with Nippon since 2017, January. So he's now been there for over 8 years, which is great. He also co-manages different schemes within the fund house, which is also wonderful. And he's had 16 years of total experience. So far, very reputable fund house, right? Good fund manager, solid fund manager. Then the other thing that we want to focus on here is the investing style, right? We'll cover this more in depth later, but right now, all we want to know is what is the investing style of the fund house. You can see words like growth themes, emphasis on quality. So you can tell right away that this fund house follows a mix, or this scheme rather specifically, follows an investing style where they mix both growth and quality style of investing together. You can go down further this list and the analysis, it gives you everything more in depth. And if you're doing it for your own investments, read each and every aspect of it because it just helps you get a better understanding of what is happening. Right, then as we scroll down this analysis, we look at the conclusion right at the end, but I also want you to pay attention to the strategy consistency. So ideally, you want to invest in a mutual fund scheme that has not noticed drastic shifts in how it invests money, because that usually indicates some sort of turmoil, some sort of change that we don't want to be a part of ideally. So here you see no recent shifts away from small cap focus, and the fund manager, right, consistently reiterates emphasis on quality growth at reasonable valuations. Now we know this because AI goes through all the interviews of the fund manager and aligns it with the portfolio and tells us if what the fund manager is saying, what the investing style is, if it matches what is actually in the portfolio. So in summary, it's a credible fund house, well suited for long-term risk-tolerant investors. So if that is you, 7+ year investment horizon, this is a fund that you can consider. Now, whether you should invest in it, we'll go through one by one as we go along in the Flash framework. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Then L stands for long-term returns. And when usually people look at returns, when they're looking at different websites, they're sorting returns as per 1 or 3 year returns. And they're looking at CAGR, which is compounded annual growth rate. I would request you to never ever look at CAGR or annualized returns. And the reason for that is, in the past 1 or 3 years, those could have been wonderful for the fund house or that particular fund, or they could have been very bad for the fund. That does not mean 1 or 3 year bad performance doesn't essentially mean that a fund is bad. At the same time, you could look at 10-year annual returns. You don't ever want to look at annual returns, you want to look at rolling returns. That is because in annual returns, you're basically looking at the starting date and the ending date. What happens in the middle is irrelevant. So even if the fund did very badly for 8 years but had very good 2 years, then the annual returns are very skewed. What you want to look at is rolling returns, because rolling returns, right, in that 10-year window, if you're looking at 10-year returns, in that 10-year window, they're looking at every single date and how the fund has done. So for example, let's say looking across a 10-year window and you're looking at 5-year rolling returns. So today is, let's say the 12th of May 2025, and you start looking at returns from 12th of May 2015. So essentially what it's going to do is, the first batch of returns that it will look at is 12th May 2015 to 12th May 2020. Then 13th May 2015 to 13th May 2020. And it will keep looking at every single 5-year window and it'll give you average returns when you're looking at rolling returns. So it gives you a better idea of consistency. Now I know this sounds complicated. You can go to Advisor Coach and basically get all of this information under rolling returns. Again, the link for that is in the description. I'm going to use DSP's website. Unfortunately, this is not available to public because I'm licensed. I get back-end access to it. But we are in the process of building a very robust mutual fund research platform, and that will be available to everyone for free. Here you will see I've compared the Nippon India Small Cap Fund versus the Nifty Small Cap 250 Index. If I just highlight the Nippon India Small Cap Fund, this is again data basically stretching from 2010. And you would right away see, right, the first batch is September 2010 to September 2015. And then this is literally tracking every single day during that window. If you notice one thing straight away, which I'm sure you have, is that the Nippon India Small Cap has consistently beaten the small cap index. And when you're choosing a fund, right, that is what you want. You want your fund to have beaten the index, if not all the time, at least majority of the time. So this has done that for a lump sum investment. Let's see for an SIP how it would have performed. Even for an SIP, you would notice that it has again outperformed the index at every single point in time. If I look at the distribution of returns, again for SIP, this is crazy, right? If you think about it, over 20% annual returns, the Nippon India Small Cap has delivered that 73% of the time. Even the index is not bad, right? Half of the time you've got over 20% returns. In terms of under 0% returns, again, possibility, right? Small caps are volatile. With the small cap index, it's 11%. With Nippon India's small cap, it is 2.6%. So even there, it's doing much better. It's doing this at a lower standard deviation. Standard deviation, I won't get into how it's calculated, but just think of it as risk or volatility, right? How much the fund moves. So it's achieved higher returns while taking on lower risk, right? Which is fantastic, which is the place that you want to be in. Now, I mentioned, you want to be invested in it for at least 7 years, and there's a reason for it. So I'll change the rolling period to 7 years. And now you will see, right, that the odds of negative returns drop drastically. For Nippon India, they are 0%. Whereas for the small cap index, they are very marginally 3.3%, right during COVID, right? The very bottom of the COVID crisis. But very soon after that, the returns became positive. So there you go. This is long-term returns. The Nippon India small cap, again, so far ticks all the boxes because it's consistently beating the small cap index while taking on lower risk. So both boxes get ticked. Next up is A for approach and asset allocation. So earlier we saw when we were doing the very basic bird's eye view research that the approach that the fund manager takes while investing in a Nippon India small cap is growth plus quality, right? Now, when it comes to where this fund actually invests, we'll go to ET Money's fund page. Just Google that and go to the ET Money page for the fund and scroll down to asset allocation. So you'll notice right away 94% is in equity, which is understandable. It's an equity fund, and within that, right, you have small cap at 67%. So for a fund to qualify as a small cap, it has to have at least 65% in small cap stocks, which this one does. But it's amongst the lowest small cap holdings across Indian small cap mutual funds, and there's a reason for it, which is Nippon India Small Cap is India's largest small cap mutual fund by how much money it manages. It's well over 50,000 crores. Now, because of that, you'll notice something again strange, but not really strange, is that the top holding, the highest allocation that this fund has is in the HDFC Bank stock. HDFC Bank stock amongst India's 3 biggest stocks. It has a place in a small cap fund. And that is because the Nippon India Small Cap is a large fund, it has to find ways to invest all the money that comes in. That's also one of the reasons why Nippon India Small Cap has now paused lump sum investments. If you want to do an SIP or an STP, the daily limit is 5 lakhs because they don't want the fund size to go out of control, right? It's already big. There's also a school of thought where if the size of a fund is very large, people believe that it wouldn't perform as well. I've done a lot of research on this because we actually handle client portfolios. The Nippon India Small Cap at times is a part of client portfolios. This is not a recommendation. We're going through it live. Your risk profile may be very different. But that has been debunked by the Nippon India Small Cap and several other large small cap funds in India. That doesn't mean that, smaller small cap funds don't do well. They have a very strategic place in your portfolio, but just because this has the biggest amount of money that it manages in the small cap space in India doesn't mean that it becomes a bad fund. It has consistently been amongst the top performers despite its fund size. It's always been one of the biggest funds in India. So I wouldn't personally rule this out just because it's a large AUM fund. In fact, let's go to value research and see what the actual AUM of the fund is. So instead of overview, we'll go to other and we'll see the AUM here. There you go. Assets. 58,000 crores. That's a lot of money that it manages, regardless of whether it's a small cap fund or not. Then let's move on to the S in our FLASH framework, where S stands for stress and stability. This is all about how a mutual fund does when things are not doing well. So if the market is dropping, how does your fund or the fund that you're interested in perform? One of the best ways to figure this out is through something called as a capture ratio. And there are 2 types of capture ratios, up market and down market capture ratio. Just to give you an idea, for up market capture ratio, and this can get complicated, but just stay with me, it will be crystal clear. In up market capture ratio, if let's say the Nifty goes up by 10% and your fund goes up by 11%, then the up market capture ratio is 11% by 10%, which is 110. In the same way, the down capture ratio calculates how your fund performs when the markets are not doing well. So for down market capture ratio, let's say the Nifty small cap index, because we're looking at a small cap fund, drops by 10%. But the fund that you have selected, the small cap fund, drops by 8%. So the down market capture ratio will be 8% divided by 10%, which is 80%. If you think about it, you want the up market capture ratio to be as high as possible and the down market ratio to be as low as possible. Because what that means is when the markets are doing well, your fund is doing very well compared to the index. Whereas if the markets are not doing well, it's falling much lesser than how much the index is falling by. And finally, there's the total capture ratio, which essentially just is a division of the up market capture ratio against the down market capture ratio. Sounds complicated. You don't have to sit and calculate this. All you have to do is go to advisorcoach.com, go to MF Research, hit the market capture ratio button, and then you will get this page. You'll have to select the equity small cap category, and I've already done that. I've already entered some of the most popular small cap funds while comparing against the Nippon India small cap. I've selected the period as 5 years and I press submit. The moment that happens, right, it will tell me right away a few things. Firstly, what is the up market, what is the down market, and what is the total capture ratio. If you notice, the down market capture ratio, which we should first look at, because as human beings, when the markets are not doing well, we just feel better if our funds are performing a little better than the market. So the Nippon India small cap has a down market capture ratio of 67, which is pretty good. But there are other funds, right? The SBI small cap and Axis small cap, which have it even lower. With regards to up market capture ratio, it's 92. Which is actually the second best, right? Quant has a up market capture ratio of 113. The rest are much lower than 92. With regards to total capture ratios, you'll see very similar capture ratios for Nippon India, Quant, and Axis small cap funds. So Nippon India is clearly not the highest, right, when it comes to capture ratio, or it doesn't have the best down capture ratio, or doesn't have the best up market capture ratio. But it's so similar to the other funds that are doing well that you do not want this to be a laggard, right? The entire idea of this is, let's say if the total capture ratio was 0.8, that's a red flag. Or if the down market capture ratio was in its 90s or late 80s when the other ones were much lower. Or even the up market capture ratio, right? If let's say it was in the 50s or late 60s, we don't want that, right? Because that just means that the fund doesn't go up as much when the markets are doing well. So this is not a ruling out category as long as it's not at the extremes. So even here, the Nippon India does pass the test that we're looking at. Okay, so now we have looked at everything, right? The fundamentals, the returns, the allocation, where it invests, the stress and stability framework. But now it's the all-important question, which is the H in the flash method, where H stands for how it fits your portfolio. Because this isn't just about whether a mutual fund is good, it's about whether it's good for you. So if you're investing in the small cap space, one of the ways to go about it is by investing in 2 small cap mutual funds, right? Because you want to kind of diversify your risk in a way, and you want 2 different kinds of funds in your portfolio. So let's say you want to invest in a Nippon India small cap fund and you want to invest in 2 small cap funds to diversify your risk. Then in that case, you want to pair it up with a fund that is very different to the Nippon India small cap. One of the most straightforward differences is the size of the fund, right? So the Nippon India small cap is the largest. Can you pair it up with a slightly smaller small cap mutual fund? So the Motilal Oswal small cap fund or the Bandhan small cap fund, they stand out. They have gone up the ranks, have an AUM of well under 10,000 crores. You can look at other funds as well, but that's one way. The second way is that you entirely look at investing styles. So you want to an opposing investing style. So the Nippon India small cap follows a growth and quality approach. What if you find a small cap fund that has the momentum style of investing? Right? That could be something that you could pair it up with. Now, it doesn't mean that you always need to have 2 different small cap funds, but it's a popular method. By having 2 different opposing investing styles or 2 different opposing funds, you're getting exposure to the entire small cap market. Alright, so if you found this video helpful, then let me know in the comments. So I'll make more videos in the Flash series. Also, let me know which funds you want me to cover, and I will. And if you enjoyed this video, Then check this one out, where I talk about when to invest in gold and when to invest in stocks and how to alternate between the two. It's a strategy based on one simple framework. Just to give you an idea, 10 lakhs invested in 1990 would have grown to 6 crores in stocks, 4.5 crores in gold, and to 90 crores in this strategy. I'll see you in the next one.